Ladies and gentlemen, I hope all of you have handed over your question slips which you distributed right at the start of the session. That's the only way we can take your questions forward and have our expert panel address the same during the question and answer session. Also, we are distributing a feedback form now, which I would request you all to kindly fill in and return to us by the end of the conference. Finally, it's your feedback that helps us get better. In the meanwhile, may I request Mr. Sabyasachi Mukherjee the right questions, to please come on stage. I would now like to call upon Ms. Soumya Gopinathan from the Times Conferences Limited to take this session forward.
Thank you, Sahil. Good evening. I'll be reading out the questions to the respective speaker with the names. Our first question is for Mr. Rao. The question is from Mr. Vignesh. The question is how to evaluate the SIP that is being offered by different financial companies and how to open SIP individually. Do we need to approach the company representative for opening?
Thanks for the first question, and indeed, don't worry, don't do too much of analysis. I always believe the word analysis leads to paralysis. What you can analyze is how long you are investing, what is your goal. Say you are investing for 5 years, come to a diversified equity fund. I was telling during the presentation, come to a fund house which has got a credibility over a period of time. It could be 10, 15, 20 years of time there, and come to a fund scheme which has performed across the cycles, not only the bull market, not bear market, across the cycles, and choose that diversified equity fund. Either it could be a balanced fund or diversified equity fund. I think that's the best way to choose your SIP. And going back, how to start your SIP, you can go to the fund house, you can go to your advisor. I believe to have an advisor, that's the best way to invest. It's not that we save small money while going direct to the fund house, but if you have an advisor, he will take care of your investments and your emotions. And when you need, and he can guide you rightly, and that's where he will take over. Otherwise, you have an option. If you have a knowledge, you can always go and to the fund house site and you can start investing with it. Hope I have answered your question.
Thank you, sir. We'll be moving on to the next question for Mr. V. Balasubramanian. The question is from Ms. Soumya. The question is, which schools are being included as a part of BSc Institute, and is it available online for everyone? And how is futures and options different from equity market, and how does it work? Two separate topics.
I hope this one works, yeah. The first question, BSc Institute, normally we actually work with quite a lot of schools. Typically, the thing is we also outreach to them, and sometimes the schools also outreach to us. For example, in Chennai, near Chennai, Vellore Institute of Technology, we have a center of excellence where actually the financial education is imparted. In fact, we have courses like finance for non-finance professionals, which is like people who go for engineering students. We want them to know a little bit of finance because they may earn a lot of stuff, but they won't know how to do it. So we do that. We have our website called bscinstitute.com. So you can actually go there. There are a lot of content and material will be there. And we also have two of my colleagues here from our Chennai regional office, Vishnu and Guru. Why don't you just come here? So they will be happy to guide anyone if some school wants to tie up, because we do it across multiple cities across the place. This is Guru and that is Vishnu. So our office is near Nungambakam. Okay. The second question is on futures and options. When you buy and sell something which would deliver immediately, it is called a spot market. Okay. And an equity market is a spot market which we call as a T+2. That means you buy today, on the second day you will have to pay money for that and receive that good. That is receive the share. In the case of futures and options, these are basically you buy today, but actually for delivery on some future date. Okay, so that is why there is an expiry period. Like for example, you are saying that I want to buy something which will come on say the 30th of the month, or say on the Diwali day, then you are actually buying what is called a future product. So you could buy that same Reliance share today in the equity market, or you could actually buy that same one on a future date. So when you do it on that future date, then what happens? You have to pay for the time value of money. Correct? It's like Today you pay some money into the bank, and then they say for 3 months you cannot take it out. After 3 months FD, they will give you some more money. That is called the fixed deposit, but that is a future. So exactly when you buy that future today, then obviously you pay a particular price. But in that price, the underlying volatility is there. So that you will have to factor in mind. And in futures, what you end up doing in spot market, if I buy for say 100 rupees Reliance share, then I will have to pay that 100 rupees on T+2. Whereas here, your 100 rupees to be paid on the 30th day. So what you do is they ask you to put a margin, say which could be say 5 rupee or 10 rupee. Why they want it? Because in case you don't pay on that day, they will want to ensure that they sell that share and that 10 rupee loss they cover. That is the future. Third, in the future, a buyer will have to similarly pay money and take it on the 30th, and the seller will have to give the share and take the money. So both sides, the same obligation is there. So it's called a symmetric product, just like an equity product. In the case of an option, the buyer basically says that I want to buy an option, and the seller says, okay, I will give you that option. At the end of that 30th day, the buyer will say, I don't want that option. So he have a right whether to take that option and take a delivery or not to take a delivery. So when you buy an insurance, you are actually buying an option from the insurance company. So exactly, this is what is the difference between what is an equity, what is a future and an option. And future and option need not be only on equity. Future and option can be on anything. We have currency futures and options. We have interest rate futures and options. You have commodity futures and gold future and option. You got on anything you can do a future and option. Any product you can do a future and option. So don't just confuse futures and options only with equity. It is something which is much more generic. And that is why I called it not an investment, I called it a risk management product. Right? Like insurance is for risk protection, same way this is for risk.
Thank you, sir. Next question is for Mr. Sabyasachi. The question is for Mr. Pradeep. What do you recommend for a long-term investor? The options given are mutual funds or equities or ULIPs.
Okay. See, as I speak, I'll just clarify one thing. Like, one thing is asset allocation, and another commonly used term is known as the diversification. Diversification is you are putting your eggs in different baskets within an assets, right? So if you want to develop equity asset allocation where you say your portfolio should be 65% equity, then 65% can be a mix of direct equity as well as a mix of mutual fund. So it can be an equity diversified scheme and a direct equity composition. If you understand equity well, I prefer sometimes, and you can manage it well, you have time for it, you can do direct equity. Otherwise, mutual funds are a better option also, because sometimes we see a bouquet of mutual funds or a portfolio of mutual funds may beat the index returns also in the longer run, because the alpha generated by the fund managers. And for ULIP, there is no comments.
Thank you. The next question is from Mr. Bandham Srinivasan. The question is from Mr. Raj. He asks, please explain about NRE demat accounts and the procedures and follow-ups linked to it. What way it's different from holding a resident demat account?
I think your question answers. Basically, there are two different categories of accounts. Resident account is a, I think it's coming. Yeah, it's okay. A resident account is for a resident Indian who opens a resident ordinary account and maintains that account. But once you become an NRI and want to open an NRI account, you need to open an NRI account. And again, in NRI, you have two categories: NRI repatriable and non-repatriable. It all depends on how you have made investments with the kind of funds what you have done. That based on that, the repatriation or non-repatriation arises. So it is for you as an individual to disclose what is your status category at that point in time.
Thank you, sir. Next question for Gaurav. It's from Mr. Kandaswamy. There are two questions. One is, given various investment products available and which are coming up, does purchasing a home, especially a flat, a good investment? And second question is, what should be the approach towards buying or renting a house?
Okay, so here is the answer. I'll remain quick. Home, from staying perspective, self-consumption, I don't think it requires any answer. We need to stay and we need to have a house. When it comes to investments, be very, very careful about it, because any kind of real estate is illiquid, indivisible, immobile. And hence you need to be very, very careful about it, because I've had situation where somebody would have a good real estate portfolio, 2-3 real estates, have given good returns, but when they wanted money, so for example, 4 real estates, total value of about 3 crores, the smallest one would be 75 lakhs and they wanted 25 lakhs money for some goal, and they either had to either liquidate that asset of 75 lakhs or take a loan. Don't get into it. Be very, very careful. Real estate is not divisible. So be very, very careful, number one. Number two, when it comes to real estate, whether we like it or not, there are cash transactions. So again, there is a second issue that comes up. Also, bequeathing real estate to next generation is also a problem, because then who will own it? Who will do the valuation? If there are two children, then one is settled here, one is outside, one wants to sell it, one doesn't want to sell it. All these problems come up. So when you do real estate from investment perspective, be very, very careful. Don't go blindly. The second part is that should we stay in our own house or should we stay in rented premises?
Yes.
I think it's a no-brainer. We have to stay in our own house. When it comes to house, shelter, when it comes to own family, don't do mathematical calculations, please. It's not making sense. So if you do mathematical rental yield and all those things, yes, I feel those mathematical calculations are brilliant, but life is not that mathematical calculation. There could be turbulences, there could be problems. Tomorrow if something happens to you, will your family members be able to generate same kind of returns which you are able to generate? Therefore, the house that you are going to be living in, house where your family is going to be staying, your wife, your children, your parents, has to be your own house. That roof above your head, that shelter is your own, fully owned. No question of renting it.
Thank you, Gaurav. Next question for Mr. K.S. Rao. It's from Mr. Clementine Joe. Question number 1 is how to invest in startups. And the second question is how to get a hard copy of companies' financial results. That's primarily for startups.
Probably it's a question to a wrong person. I mean, startups, honestly, I do not have an idea. I'll pass it on to the Bala.
You're not listed.
Probably I'll take it up. Startups by nature are basically unknown companies. That is basically some entrepreneur starts it off. It's typically the case of a SME. He will normally want some investment. He will either go to his family, friend, his own relatives or whatever. And at the most, if he needs to raise some more capital, then he will try to go to some angel funds or a venture capital fund or a private equity fund. Now, what is changing now with the new regulations of SEBI is, SEBI has come up with a new rule which says that startup exchange listing segment they are going to create. And in that, they are going to say that any company which is going to come up in that startup segment, it has to be of a high technology nature. That is the first condition they have put. The second thing is that when they come up with the public issue for listing, they will have to have at least 200 investors who will have to invest at least 10 lakh rupees each. Because see, startups are going to be extremely risky. There is a young boy or some person who is trying to become an entrepreneur. There is no guarantee for any investor whether he will really make money or even return your own capital back to you. So that is the reason why they put a threshold of saying that if you are really wanting to back something, then you have to look at least investing 10 lakhs. Even on the SME, for example, they have prescribed a minimum investment of 1 lakh, which means small investors will want to always be, if you are worried about your money, then you have to invest in well-proven companies, which have become matured. But if you want to do on a startup, you are clearly looking at some extremely risky investment. So that you should be mindful of.
I just add, we as a company, IIFL, which I represent, we had a investment avenue where we invest for startups and all. So if you want details and all, our representative is there. Praveen is there, our Chennai office is there, you can walk in. It requires definitely a substantial amount of money, but you can be a part of a startup and sunrise industry. So we have got opportunities for investments in that.
So probably at some point, Birla Mutual Fund might create a startup fund. So you can invest in that and they will invest only in startups.
That's nice, Bala. And
Thank
thanks, Joe, for that question. I think it has even enlightened us too. And probably I only say start investing, but not startup investing.
Thank you. Next question for Sabyasachi. The question is how to identify the best share and also the best indicator for stock performance. And also, is there any pharmaceutical ETF fund? And okay, I think there's one more question. The investing in ETF, is it safer than investing in shares?
I didn't get the last
Okay, the first question was how to identify the best share and the best stock performance indicators. And are there any pharmaceutical ETF funds? And how is investing in ETFs safer than investing in shares?
Okay. I'll just take the questions one by one. The first question, how to identify good shares and all. See, basically, when we do take out a research note on a company, being a part of the research team, we generally speak with the management, attend the con calls, we look at the balance sheet of the company, we look at the peer group, we look at the sector where it is working. So a lot of things works together. So generally when we summarize it, we say it's a top-down or a bottom-up approach that we follow. We look at the economy or the whole sphere, we look at trim down to companies, and then we look at the respective shares. So better is to go through some kind of, as people were speaking of BSc courses and all. So there are definite courses where the equity research is taught to a great extent. I think BSc Institute also is having one. So you can undergo one of those courses to understand, but it comes with experience, and you have to be patient to understand how to pick up a wonderful stock. But once you have picked up a wonderful stock, my only suggestion remains, be with it. If you understand a stock, it is fundamentally strong, where you have got faith in the business, in the management, because I always say the promoter is of vital importance. Understand what the promoter is. So for this, you go through the annual report. Annual report are hosted on the exchange. BSc, if you visit the websites, you will get the annual reports. If you are a shareholder, you will get it by post. So you go through the annual report, read the comments of the directors, you read the auditor's note, you read the contingent liability portions. So you will get a idea where the company is progressing to, or what it wants to do. So after reading all this, I think you can pick up a good company.
And another one was, are there any pharmaceutical ETF funds?
See, ETFs, pharmaceutical funds have done substantially well. It has got, I think, more than 40% return in last few years. As a sector, if you ask me, it has losing steam to some extent, maybe because the PE ratios of most of the stocks have gone up to a great extent, maybe multi-year highs. So there are pharmaceutical funds that I know are in existence of good AMCs, but as far ETFs are concerned, I don't think there is any. So ETFs are mainly in the gold and the NSE Nifty ETFs that you generally find, and also there is one, the PSU one CPSE, CNX 500, mainly the indices ones, and also another one that we generally recommend, or it's good to buy, was the CPSE ETFs. Bank ETFs are also, yeah. Any kind of indices you see there, it can be a ETF, because ETFs buy the underlying, that's the main thing.
Thank you. Next question for Mr. Rao. The question is, what's the tax on liquid funds?
Liquid funds, if you are coming to the dividend option, the dividend is tax free because we pay the dividend distribution tax. But if you are coming to the growth option, if you are coming for the less than 3 years period of time, it is above 3 years, it attracts the long-term capital gains. Less than 3 years, it's the short-term capital gains. It will be added to your income and it will be taxed accordingly. And if you are a taxpayer, I think you can choose for the dividend option. It is a tax free, and you need not worry, whatever is coming is tax free to you. Probably that's the best way to look at.
Thank you. Next question for Mr. Bandham Srinivas. The question is, how do financial institutions plan for a virtual infrastructure? And what are the charges for using NPS tier accounts, NPS tier 1 accounts?
Okay, NPS tier 1 account, as I said, you need to open through a point of presence, an entity called POP. Again, these entities are not new entities. There are banks who are offering these services. So you need to contact them and check the charge structure with them, and according to that, they'll be charging it to you. It is not directly the CRA. Actually, NSDL group company acts as a central record keeping agency. I mean, we maintain, administer, and provide the customer services to the subscribers of the pension account, that is the PRAN account. So you need to contact a POP who's the actual front end user for you, or a front interface for you to avail the service. So they'll be charging you the account fee. So those charges you need to check out with them and then avail the service. It is not that CRA charges you directly.
Thank you, sir. The last question for Mr. Gaurav. The question is, relatively speaking, which is more critical, asset allocation or security selection?
Obviously, asset allocation, because selecting a security should be based on your asset allocation. If your asset allocation, I mean, selecting securities, in fact, just a secondary activity once your asset allocation is right. If you have gone wrong with the asset allocation, even if your securities are right, that's not good. I already gave an example where you could have a lot of real estate, and if you require money, and if you require money which is less than the cost of the that particular real estate, it's going to create a problem. So do not look at securities first, start looking at the asset allocation. Once that's done, then look at various options and say, for example, if it's equity, then do you want to do it direct equity, you want to look at equity mutual fund, or any other options possible. So first asset allocation, then security selection.
Before I add to this, not as a question, but the goal planning book which we have given, along with that today, instead, thanks to Raviji for launching that, and at the same time simultaneously we have from today there is a goal planning app is available on the Google Play Store, which is free of cost, where you can see to achieve your goals even suggested mode of investment, whether it's a diversified equity or mid cap, or you want to have a short term funds. It is not the Birla products, it's as a product basket which is given. Probably you can go to the Google Play Store and download Birla Sun Life goal planning calculator, which